In this video, we are going to see how to select stock for investment. Selecting stock is not a magic. When it comes to selecting stocks for an investment, there is a few key factors that investors should consider in order to mitigate market risk and increase the likelihood of generating positive returns. We should not select a stock just randomly from the list, either Nifty or Bank Nifty or any other mid cap or small cap stocks. Here are some key steps to follow. First, conduct thorough research. Before investing in any stock, it is important to do your homework. Research the company's financial statement, management team, industry trend, and competitive landscape to get a sense of how the company is positioned within the market. Look for any potential red flags such as declining revenues or profits, excess debt, or lack of innovations. Second, evaluate the company's growth potential. Consider whether the company is likely to experience growth in the coming years. Look for signs that the company has a solid strategy for expanding its market share, developing new products, or entering new markets. Thirdly, assess the company's valuation. Determine whether the stock is priced fairly based on the company's financial performance and growth prospects. Consider the factors such as PE ratio, price to earnings ratio, price to book ratio, and dividend yield. Fourthly, economic conditions. Economic conditions such as interest rates, inflation rate, and GDP growth can have a significant impact on certain sectors. For example, rising interest rate can negatively impact on real estate and consumer sector, while they may positively impact on finance sector. Moreover, you need to see the market trends in technology and demographics and consumer behavior can also have an impact on the different sector and different stocks. For example, the healthcare and technology sectors may benefit from aging populations and increased demand for healthcare and technological solutions. While investing, we need to see the price of the share or stock. Sometimes the stock price may be overvalued or undervalued. A low price stock may be attractive to some investors because it requires a smaller initial investment, which may be more suitable for those who limited funds or a desire for diversification across multiple stocks. However, a low priced stock may also indicate that the company is experiencing financial difficulties or is in a less competitive position within its market. On the other hand, a high priced stock may indicate that the company is well established, has strong financial, and is expected to experience the growth in the future. However, a high priced stock may also be overvalued and subjected to great volatility. It's important to consider a company's earnings release schedule when evaluating a stock for investment. Earning reports can provide valuable insight into a company's financial performance, including revenue growth, profitability, and future prospects. Most publicly traded companies releasing earnings report on the quarterly basis, typically several weeks after the end of the fiscal quarter. Investors and analysts closely scrutinize these reports, looking for any signs of strength or weakness in the company's financials. Next, we will see about long-term investing and short-term investing. When considering the stock selection, you need to consider whether you are going to invest for long-term or short-term. Generally, the long-term involves buying and holding investment for an extended period, typically several years or more. tends to be less volatile than the short-term investing, as it allows investors to ride out market fluctuations and benefit from the power of compounding returns. May be more suitable for investors with a longer time horizon, such as those savings for retirement or other long-term goals. Can be a good strategy for investors who are seeking steady long-term growth and are willing to withstand short-term market volatility. In the case of short-term investing, involves buying and selling investments within a relatively short time frame, typically several months or less. Tends to be more volatile than long-term investing. Short-term investments are more susceptible to market fluctuation and the other factors that can impact stock prices in the short run. May be more suitable for investors who are seeking quick profits or who have high tolerance for risk. It can be a good strategy for investors who are looking to take advantage of short-term market trend or who have specific financial goals that require more immediate returns. Evaluating dividend-paying stocks is very important during the selection of stocks. Dividend-paying stocks can provide a reliable source of income for investors seeking regular cash flow from their investments. Historically, dividend-paying stocks have tended to outperform non-dividend-paying stocks, especially during market downturns. Dividend-paying stocks tend to be more established and financially stable companies, which may make them less volatile and less risky than non-dividend-paying stocks. However, high dividend yield can sometimes be a warning sign of unsustainable payout ratio or other financial troubles. So it is important to consider all egg should not be there in the single basket. So you need to create your portfolio by investing the different sectors in the market. So we can reduce the risk. We can maintain the portfolio profitable. One more thing I would like to add here is that better to put stop loss in the investment journey. Yes, it can be beneficial to use stop loss order when investing in stocks. A stop loss order is an instruction to sell a stock if the price falls to a certain level, which can help to limit the potential losses. By setting a stop loss order, an investor can protect themselves from the downside risk of a stock that experiences a sudden drop in the price. If the stock price falls to the level of the stop loss, the order is triggered and the stock is sold automatically, limiting the investor's loss. However, it is important to note that stop loss orders are not a foolproof and may not work in all market conditions. In volatile market or during a rapid decline in the stock price, the price at which stop loss order is executed may be significantly lower than the intended level, resulting in a large loss than the expected. That's all about how to select the stock. If you like the content, please do subscribe our channel.